I said at the time that it was going to take time, and the major reason for that, of course, was the growth of the global south, the growth of China, Russia, and other countries, and the fact that these countries, the non-G7 countries, were trying to basically become less dependent on the dollar system.
I want to, again, my predictions on this were 17 years ago. And it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Gold's recent performance has underscored its enduring role as a cornerstone of financial security, with prices pushing higher as investors brace for continued monetary and geopolitical uncertainty. The metal has held firm against market volatility, supported by central bank accumulation, supply tightness, and a shift in sentiment away from fiat currencies. As inflationary pressures persist and confidence in paper assets weakens, gold is increasingly being viewed not only as a safe haven, but also as a forward-looking hedge against systemic risk. This backdrop has created conditions for a powerful upward trajectory, one that analysts believe is only just beginning to unfold. MikeMaloney, a longtime advocate of precious metals, has projected that gold could ultimately reach $5,000 per ounce, citing structural weaknesses in the global financial system. According to Maloney, decades of credit expansion and currency debasement are converging in a way that leaves gold as one of the few assets capable of preserving wealth when traditional markets falter. He points to accelerating demand from both retail and institutional buyers, as well as central banks diversifying away from the US dollar, as signals that higher valuations are not only possible but likely inevitable. For Maloney, the move toward $5,000 gold is less a speculative call and more a reflection of what happens when trust in fiat money begins to erode on a global scale. The implications of such a move would extend far beyond individual portfolios, reshaping the balance of financial power worldwide. A gold price of $5,000 would signal not only a loss of confidence in traditional currencies, but also a revaluation of monetary assets as a whole. It would challenge policymakers and recalibrate investor strategies across asset classes. For those holding physical gold, the outlook suggests not just protection, but potentially generational wealth preservation, while for the broader system, it highlights the fragility of a financial order heavily reliant on debt and fiat credibility. In Maloney's view, the road to $5,000 gold is not a matter of if, but when. Before we dive into Mike's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Well, I think actually it's if Trump undermines the Fed, with gold, 5,000 is a ridiculously low price. It's just stupid, idiotic low. You have to put a 1, a 2, maybe even another 5 in front of that 5,000. But the very fact that they are saying this, and John Paulson just said $5,000 an ounce, and JP Morgan just said $5,000 an ounce, and people are reading it. So Goldman Sachs has finally woken up. I was saying, my analysis in my first book, I had 3 different ways of looking at it, and I came up with a range of the low 6,000s to the mid 6,000s. But that was back then when the debt was so small and when the dollar was, in a much better position. But the main thing here is that Goldman Sachs is writing positive stuff about gold. They were so negative on gold when gold was $700 an ounce, $400 an ounce. That's when, no, you don't want any gold. You want what we sell. Now, gold has proven them so wrong. All these people, JP Morgan, Goldman Sachs, they are so incredibly wrong year after year after year. And now they're jumping on the bandwagon here because they're looking like idiots. But the fact that they are saying this, even if Trump does nothing, could cause gold to go to $5,000 an ounce. If Trump does something that undermines the Fed, $5,000 an ounce is an absolutely idiotic prediction. It is absurdly low.
Yes.
So that's my That's my comment.
I agree completely. And wait until you see the logic that they use, the numbers that went into it. You're still going to continue to think it's a low estimate. So gold prices could climb to almost $5,000 an ounce if Donald Trump's attacks on the Federal Reserve damage the U.S. central bank's independence, Goldman Sachs has predicted. Okay, so that's basically the same as the headline. The other data point that's interesting here, if 1% of the privately owned U.S. Treasury market were to flow to gold, the gold price would rise to nearly $5,000 per troy ounce. 1%.
1%. Well, first of all, if anybody that bought the Great Gold and Silver Rush of the 21st century, and they've read the chapter on Giffen goods and about the panic that happened back in 1979, first month of 1980, and then the differences between the bull market of the 70s and today, if 1% start going toward gold and it goes toward $5,000 an ounce quickly, then 2% are going to go, 3%. And then there's going to be a rush of a whole bunch of other people where it's not treasuries that they're selling, it's other things that they're selling. It'll be stocks and real estate, and everybody starts to gravitate toward the thing that's going up fastest, toward the thing that is the ultimate safe haven investment, especially in turbulent times, war, all of this stuff. When the public comes rushing in, and they're not right now. The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will, then we're going to see some real fireworks. But right now, Asia has lit the fuse, and this is part of lighting the fuse. Goldman Sachs writing this stuff, JP Morgan writing this stuff, and big successful investors like Paulson writing this stuff. Now that it's getting out into common public knowledge, I want to, again, my predictions on this were 17 years ago, and it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000. You and I spent 4 years researching this, and we know, you and I know, that this time it's really different.
Gold continues to demonstrate resilience in global markets, maintaining upward momentum as investors hedge against inflationary pressures and an uncertain monetary environment. Analysts note that the metal's price action is increasingly underpinned by both macroeconomic stress and strong physical demand, particularly as central banks diversify away from the US dollar. Among the most important players in this shift is China, whose steady accumulation of gold underscores a strategic effort to reduce reliance on dollar reserves while reinforcing the yuan's credibility in international trade. This persistent buying has tightened available supply and provided a firm base for higher valuations, keeping gold in focus as a key asset for both private and institutional investors. Economist MarioInnecco has emphasized that China's gold strategy is not only about reserves, but also about reshaping the global financial order. By steadily increasing its holdings, China is building leverage in a system where confidence in fiat currencies is already fragile. Innecco argues that this long-term approach effectively places a floor under gold prices, since China's consistent demand provides stability, even during periods of market correction. For investors, this dynamic highlights the dual forces shaping gold's outlook: immediate bullish momentum from economic uncertainty, and a structural revaluation fueled by the largest emerging economy actively anchoring its financial future in physical gold.
Today we're going to talk about the dollar and the yuan. I've been warning since 2017 that the petrodollar was going to decrease in importance. I have a petrodollar files in my playlist. I have a playlist called the petrodollar files. And I said at the time that it was going to take time. And the major reason for that, of course, was the growth of the global south, the growth of China, Russia and other countries, and the fact that these countries, the non-G7 countries, were trying to basically become less dependent on the dollar system, not because they want to like destroy the dollar, but because they want to be more self-reliant. They don't want to depend on the dollar alone. And one of the reasons for that, of course, has been the regime of sanctions and other political punishments by the US in the last 15 years. And it's akin to you having a bank account with a particular bank, and this bank starts making it hard for you to deal with them. Well, you're going to look for another bank. And I think the Global South, or the BRICS, if you want to call it, really, they're not really looking for another bank. They're not really looking for another reserve currency. They're looking for another system that they can deal amongst themselves, that they don't have to go through the US dollar, a third-party currency. And yes, back in 2017-18, when I started talking about this, and what I want to talk about today is something about the bond market, which is a market that, of course, I worked in for over 20 years. It wasn't the corporate bond market, but it was the government bond market. But it's a very important market. The bond markets are the biggest markets out there. They're bigger than the stock market or the equity market. And I remember Jim Rickards actually talking about reserve currencies and whether the yuan or the Chinese renminbi would become a major reserve currency. I don't remember exactly how many years ago, maybe at least 5, maybe 7, 10 years ago, he said, yeah, China is not never, but he said it would take decades for them to have a major part in the world's monetary architecture, trade architecture, because they don't have a bond market like in the US, a deep bond market, but that's also changing very quickly. China seems to do everything very quickly and very well. And I'm not like defending China or its political system. I'm just looking at the facts. And that's what a lot of people have a problem doing. They get too bogged down in the politics and things like that, instead of looking at the numbers and the facts, of course. So I'm seeing a lot of stuff about China. For example, Vince Lancy posted this yesterday. Yuan bond growth. Countries are beginning to issue debt in yuan. Hungary's 5 billion yuan panda bond in July was the largest sovereign deal of its kind, while Russian energy firms are preparing yuan-denominated paper. So 5 billion yuan is under $1 billion. That's pretty small. But we're also seeing that other countries, and I think I spoke about this a couple of weeks ago or so, like developing countries, are swapping out of a dollar debt to cut borrowing costs. And they're resorting to issuing Chinese yuan or renminbi bonds, or sometimes even Swiss francs, because they cost less. So there's the FT reporting it. That was from September 2nd. And I received something from one of the viewers about an Australian company called Fortescue Mining. What do? Well, they're the 4th largest iron ore producer in the world. They're the 3rd biggest Australian iron ore producer. And the biggest ones are BHP and Rio Tinto. But according to the research I've done, Fortescue is a major producer, and it's been growing quite a bit over the recent years. The biggest iron ore producer in the world is Vale, which is a Brazilian mining giant. But anyway, what's that got to do with de-dollarization and the growth of the yuan overseas yuan bond market. And that has been one of the linchpins, an overseas bond market for demand for the dollar. In London and in Europe, we've had what's called the Eurobond market, where dollars abroad are issued or lent to corporations. And that's what the Eurobond market is all about. Dollars that are parked abroad. And there's a Eurobond market also for other currencies. Most people think there's only the euro dollar, but that's not true. Anyway, I have to thank the viewer for sending me this. I wouldn't have known about this. About a week ago, August 8th, exactly a week ago, this came out. Australia's Fortescue secures yuan loan worth $2 billion. That's US dollars, which is about 15 billion yuan. So it's quite a bit more than what Hungary issued. And it says 4 green energy plans, and you might have whatever opinion on this green energy and climate change. But be as it may, this is happening.
Looking ahead, gold's trajectory points toward a future where its role expands far beyond a traditional safe haven. With global debt climbing, central banks softening their stance, and geopolitical rivalries intensifying, gold is positioned to gain prominence as both a financial hedge and a strategic asset. If China and other emerging economies continue their accumulation at the current pace, the pressure on Western markets could translate into a long-term repricing of gold well above historical norms. In such a climate, the real question is not whether gold will reach new highs, but how this shift will redefine the balance of power in global finance as nations and investors alike recalibrate their trust away from paper assets toward enduring value. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.